Hey, what is up, everyone? Welcome back to the channel. I am Mano, and if you are new here, a massive warm welcome to you. Hit that subscribe button and tap the bell because every single week I bring you content that is going to change the way you think about money, investing, and building a life of financial freedom. Now, before we begin today's video, I want to ask you something. I want you to be honest with yourself. Have you ever, and I mean ever, felt completely lost when it comes to investing your money? Like, do you sit there wondering, should I put my savings in stocks? Should I invest in crypto? Should I just keep it in a fixed deposit and forget about it? Have you ever panicked when the market crashed and sold everything out of fear, only to watch it bounce back and recover without you? If you said yes to any of those questions, then today's video is made specifically for you. Because today, I am going to break down one of the most powerful, most transformative, most life-changing books ever written about investing. And this is not just me saying that. This book has been praised by the greatest investor alive, Warren Buffett himself. The book is called The Intelligent Investor by Benjamin Graham. This book was first published in 1949. Let me say that again, 1949. That is over 75 years ago, and yet it is still considered the greatest investing book of all time. Why? Because the principles in this book do not have an expiry date. They were true 75 years ago, they are true today, and they will be true 75 years from now. Today, I am going to take you through this book like you have never seen before. We're talking real data, we're talking real numbers, we're talking shocking statistics, we're talking life lessons that will fundamentally change how you look at your money. This is going to be one of the most valuable videos I have ever made, so stay with me till the very end. I promise you it will be 100% worth your time. Let's get into it. Before we get into the lessons, let me tell you about the man who wrote this book, because understanding who Benjamin Graham was is going to make everything that follows 10 times more powerful. Benjamin Graham was born in London in 1894 and grew up in New York City. His family lost nearly everything when he was just a young boy. His father died, his family fell into poverty, and young Benjamin watched his mother struggle to survive the stock market crash of 1907. That early experience with financial loss shaped everything he later became. It gave him a deep obsession with understanding risk, protecting capital, and making rational financial decisions. Graham went on to study at Columbia University and graduated at just 20 years old, near the top of his class. He started working on Wall Street, and over the next few decades, he built one of the most legendary investing track records in history. His investment firm, the Graham-Newman Corporation, delivered an average annual return of approximately 17% per year between 1936 and 1956. During that same period, the overall stock market returned around 12.2% per year. That is a massive outperformance year after year for 2 decades. But perhaps his greatest achievement was not his own wealth, it was the students he taught. At Columbia University, Graham taught a class on investing, and one of his students changed the entire world of business. That student's name? Warren Edward Buffett. Warren Buffett, the man who is currently worth over $130 billion as of 2024, has said publicly multiple times that Benjamin Graham is the second most influential person in his life after his own father. Warren Buffett read The Intelligent Investor for the first time at age 19. He later said it was the best book on investing ever written. He was so inspired that he applied to Columbia University specifically to study under Graham. This is not just a book, this is the foundation upon which one of the greatest fortunes ever built was laid. So, if you've been looking for a reason to take this book seriously, Warren Buffett's $130 billion net worth should be more than enough reason. The Intelligent Investor is by far the best book about investing ever written. Warren Buffett. All right, guys, this is where it gets really interesting. Before I get into the specific lessons from the book, I want to hit you with some real-world data and statistics because these numbers are going to completely change the way you see the stock market and investing. Ready? Let's go. The S&P 500, which tracks the top 500 companies in the United States, has delivered an average annual return of approximately 10.5% per year since its inception in 1957. That number includes every crash, every recession, every war, every pandemic, every financial crisis. Through all of that, the average return is still over 10% per year. Now, let me put that in perspective. If you had invested just $10,000 in the S&P 500 back in 1980 and done absolutely nothing, just sat on it, by 2024, that investment would be worth approximately $1.09 million. You did nothing. You made no smart trades. You just held on with patience. That is the power of long-term investing that Graham talks about in this book. Here's a statistic that is going to humble every person watching this video, including me. According to the SPIVA scorecard published by S&P Global in 2023, over 92% of actively managed funds managed by professional fund managers with degrees, teams, expensive software, and years of experience failed to beat the S&P 500 index over a 15-year period. Let me say that again. 92% of professionals with all the resources in the world could not beat a simple index. Why? Because they trade emotionally. They try to time the market. They buy when things are hot and panic sell when they crash. Graham predicted this behavior back in 1949 and warned investors against it. The data proves he was 100% right. According to a study by Dalbar Inc., a financial services research firm, the average equity mutual fund investor earned only 3.7% per year over a 30-year period ending in 2021, even though the S&P 500 returned over 10.6% per year during that same period. The gap, a staggering 6.9% per year, was lost entirely to emotional decision-making, panic selling, chasing hot stocks, and mistiming the market. Over 30 years, that gap represents hundreds of thousands of dollars in lost wealth for the average investor. Let's get even more specific. The S&P 500 experienced 26 separate corrections of 10% or more between 1928 and 2023. In every single case, the market eventually recovered and went on to reach new all-time highs. The average time to fully recover from a market crash was approximately 2 years, yet most investors panic and sell during these corrections, locking in their losses permanently. Graham's message was simple. The market will always go up and down in the short term, but in the long term, it has always gone up. Your job as an intelligent investor is simply to not get in your own way. And now you understand exactly why this book matters. All right, guys, now we get to the meat of the video. Graham packed this book with incredible wisdom, and I'm going to walk you through the most powerful lessons in plain, simple language that anyone can understand. Let's get into it. Lesson 1. The difference between investing and speculating. Graham opens the book by drawing a clear line that most people today completely ignore. He defines an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. He says anything that does not meet this definition is speculation. Think about that. When you buy a stock because your friend told you it's going to 10x, or because you saw it trending on social media, that is not investing. That is speculating. When you buy crypto because everyone around you is buying it and you have FOMO, that is speculating. Graham says speculation is fine if you do it with a small amount of money you can afford to lose, but never, ever confuse speculation with investing. They are two fundamentally different activities. Now here's where it gets personal for me. Early in my investment journey, I made this exact mistake. I threw money at stocks I did not understand because everyone was talking about them. I lost money, and when I finally read this book, I realized what Graham was trying to warn me about all along. The painful lesson of my life was right there in the first chapter. That is why this book hit me differently. Benjamin Graham says, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return." Lesson 2. Mr. Market, the most important analogy in investing history. This is without a doubt one of the brilliant concepts in all of financial literature. Graham asks you to imagine that you own a small business with a partner. This partner's name is Mr. Market. Every single day, Mr. Market comes to you and offers to either buy your share of the business or sell you his share at a price he decides. Here's the thing about Mr. Market. He's emotionally unstable. Some days he's wildly optimistic. The business is doing well, the economy is booming, everyone is happy, and Mr. Market offers to buy your shares at a very high price. Other days, he's terrified and depressed. The news is bad, everyone is panicking, and Mr. Market offers to sell you his shares at a very low price. Now, what should you do? Graham says this: Mr. Market is there to serve you, not to guide you. When he's depressed and offers you great stocks at low prices, buy from him. When he's euphoric and offers to buy your stocks at inflated prices, sell to him. But never, ever let his moods influence your judgment about the actual value of your investment. This sounds simple, right? But think about how we actually behave in real life. When the market crashes and prices fall, most people sell. When the market is booming and prices are at all-time highs, most people buy. We do the exact opposite of what Graham recommends. We follow Mr. Market's emotions instead of controlling our own. And that's precisely why most investors lose money. Between February 19th and March 23rd, 2020, during the COVID-19 pandemic, the S&P 500 crashed by approximately 34% in just 33 days. It was the fastest crash in U.S. market history. Millions of investors panicked and sold, but those who followed Graham's philosophy, who stayed calm, who saw Mr. Market in a panic, who bought more, were rewarded handsomely. By August 2020, the market had completely recovered. By the end of 2020, it was at new all-time highs. The people who sold in March 2020 missed one of the greatest recovery rallies in market history. Master Lesson 3: The Margin of Safety, Graham's Golden Rule. If I had to pick one single concept from this entire book that has made the biggest difference in my financial life, it would be the margin of safety. This is Graham's golden rule, his sacred principle, and it's devastatingly simple. Graham says, never pay full price for anything. Always demand a discount, a cushion between what you pay and what something is actually worth. That gap is your margin of safety. It protects you when things go wrong, and in investing, things always go wrong at some point. Here's a real-world example. Imagine you analyze a company and you determine that its stock is worth 100 rupees per share. Graham says, do not buy it at 100 rupees. Wait. Be patient. Buy it only when it drops to 60 or 70 rupees. That 30 to 40 rupee discount is your margin of safety. If your analysis was slightly wrong, that cushion protects you. If the market dips further, that cushion absorbs the blow. You win because you built protection into your decision from the very beginning. Warren Buffett once said that margin of safety are the three most important words in investing. 3 words: margin of safety. If you leave this video with nothing else, leave with that. Let me put this in data terms. Research has shown that buying stocks at a significant discount to their intrinsic value, which is essentially what Graham's margin of safety strategy demands, has historically outperformed buying stocks at full market price by approximately 3 to 5 percentage points per year over long periods. Over 20 or 30 years, that difference compounds into an absolutely life-changing amount of additional wealth for the average investor. Benjamin Graham says, confronted with the challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. Master Lesson 4, defensive investor versus enterprising investor. Which one are you? Graham divides all investors into 2 categories, and I love this framework because it's so practical and honest. The first type is the defensive investor. The second is the enterprising investor. Neither is better than the other, but it is absolutely critical that you know which one you are because the strategies are completely different. The defensive investor is someone who values simplicity, safety, and peace of mind above maximum returns. They don't want to spend hours researching stocks. They don't want to actively manage their portfolio. They want to invest their money intelligently, with minimum effort and worry, and achieve a satisfactory return. Graham's advice for this investor is straightforward. Maintain a balanced portfolio of 50% stocks and 50% high-quality bonds. Buy diversified index funds. Invest regularly, regardless of market conditions. Rebalance once or twice a year, and then leave it alone. The enterprising investor is someone who is willing to put in serious time and effort to research individual stocks and achieve above-average returns. This investor actively searches for undervalued companies, analyzes financial statements, understands business fundamentals, and looks for situations where Mr. Market has mispriced something. Graham says this type of investor can beat the market, but only if they're willing to do the hard, unglamorous work. Here's the honest truth that Graham gives us. If you're not prepared to do the deep research required of an enterprising investor, then you should be a defensive investor. Trying to be an enterprising investor without doing the work is the worst of all possible positions. You take on active risk without the active research that would justify it. That's how people lose money. Mano's personal experience? I tried to be an enterprising investor without putting in the work. I paid the price. Now I approach investing with humility, patience, and a clear understanding of what kind of investor I am at any given moment. That shift alone, understanding my own investor type, made me significantly more disciplined. Master Lesson 5. Stock market fluctuations are your friend, not your enemy. One of the most counterintuitive ideas in this entire book is Graham's perspective on market volatility. Most people, most normal human beings, are afraid of market fluctuations. When prices fall, they feel fear. When prices rise, they feel greed. Both of these emotions are completely natural, and both of them will destroy your investment portfolio if you let them drive your decisions. Graham flips this completely on its head. He says the intelligent investor should welcome falling prices because falling prices mean better buying opportunities. If you're a long-term investor who is still accumulating wealth, then falling prices are your friend. You are buying more shares for the same amount of money. It is like your favorite product going on sale. He also warns against the equally dangerous emotion of greed during rising markets. When everyone around you is making money and stocks are at all-time highs, the temptation to jump in and buy everything in sight is overwhelming. But that is precisely when prices are most inflated and the risk of overpaying is highest. Graham says the intelligent investor does the opposite of what feels natural, and therein lies the entire challenge and the entire opportunity of investing. Historical data supports this beautifully. A study analyzing the returns of investors who stayed fully invested in the S&P 500 from 1993 to 2013 found that if you had missed just the 10 best trading days during that 20-year period, your total return would have been cut almost in half. The best days in the stock market almost always come right after the worst days. The investors who panicked and sold during crashes missed the best recovery days and paid a devastating price for it. Lesson 6. Never overpay. The price you pay determines your return. This is a lesson that sounds almost painfully obvious when you hear it, but that most investors in the real world consistently ignore. Graham says the price you pay for an investment determines how much money you make from it. Pay too much and you will lose money, even if the company is great. Pay the right price, or better yet, a discounted price, and you will make money, even if the company is just average. The dot-com bubble of the late 1990s is a perfect real-world example of this principle in action. Companies with no profits, no revenue, no viable business model were trading at astronomical valuations simply because the word Internet was attached to their name. The NASDAQ index, heavily tech-focused, rose by over 400% between 1995 and 2000, and then it crashed. Between 2000 and 2002, the NASDAQ lost approximately 78% of its value. Trillions of dollars in wealth were wiped out. The companies had not suddenly become worthless. Many of them had always been overpriced. Investors who had followed Graham's principles and refused to overpay were safely on the sidelines, watching others learn painful lessons. Graham gives us very practical tools for assessing whether a stock is reasonably priced. He looks at the price-to-earnings ratio, or PE ratio, and suggests that a defensive investor should generally not pay more than 15 times the company's average earnings over the past 3 years. He also looks at the price-to-book ratio and suggests keeping it below 1.5 times. These are simple, concrete, practical filters that help you avoid overpaying no matter how excited everyone else is about a particular stock. Lesson 7. The most important quality: emotional discipline. We've saved the most important lesson for last because without this one, none of the others matter. Graham says, and I believe this with every fiber of my being, that successful investing is not about intelligence. It is not about complex mathematical formulas. It is not about having access to insider information or sophisticated software. It is about temperament. It is about emotional discipline. Your IQ does not determine your investment returns. Your EQ, your emotional intelligence, does. The ability to stay calm when everyone around you is panicking. The ability to be patient when the market is testing your resolve. The ability to think rationally when your emotions are screaming at you to do something, anything, right now. That is what separates the intelligent investor from everyone else. Graham makes this point powerfully when he says the investor's chief problem and even his worst enemy is likely to be himself. Not the market, not the economy, not interest rates, himself, his own emotions, his own biases, his own impatience. Research from behavioral finance completely validates this. Nobel Prize-winning psychologist Daniel Kahneman, in his groundbreaking work on decision-making and investing, showed that human beings are predictably irrational when it comes to financial decisions. We feel the pain of losing money roughly twice as intensely as we feel the pleasure of gaining the same amount. This asymmetry, called loss aversion, causes investors to make terrible decisions because they're trying to avoid the feeling of loss rather than making rational decisions about actual value. Now, a lot of people ask me, Mano, this book was written in 1949. Is it still relevant today in 2024? And my answer is an emphatic yes. But let me explain why and also acknowledge where the world has changed. Graham's core principles, emotional discipline, margin of safety, understanding intrinsic value, distinguishing investment from speculation, are timeless. Human psychology has not changed. Fear and greed still drive markets today, just as they did in 1949. The same cycles of boom and bust, panic and euphoria continued to repeat themselves decade after decade. Look at the cryptocurrency market as a modern example. Between 2020 and 2021, Bitcoin rose from approximately $7,000 to nearly $69,000, a gain of nearly 900% in about 18 months. Millions of people rushed in, driven purely by FOMO and the dream of overnight riches. Then, between November 2021 and November 2022, Bitcoin fell by approximately 77% from its peak. Billions of dollars in wealth were wiped out. People who had bought at the peak, driven by excitement rather than analysis, suffered devastating losses. Graham would have looked at this scenario and said, this is what happens when speculation masquerades as investing. Now, Graham did not specifically address cryptocurrency, of course, but his question would be simple. What is the intrinsic value of this asset? What are its earnings? What fundamentals support its price? When you cannot answer these questions with confidence and you buy it anyway, you are speculating, not investing. Nothing wrong with speculating, but know what you are doing. The rise of index fund investing, championed by John Bogle and others who were heavily influenced by Graham, is perhaps the greatest validation of his defensive investor philosophy. The Vanguard Total Stock Market Index Fund, for example, has delivered annualized returns of approximately 7.6% per year over a 30-year period. Beating it consistently year after year has proven nearly impossible, even for the most sophisticated institutional investors. Graham's defensive investor, quietly and patiently investing in index funds, has consistently beaten the majority of active investors. The data is unambiguous. All right, people, theory is great, but what do you actually do with all of this? Let me give you my practical action steps, things you can start doing today based on Graham's principles. Action step 1. Identify which type of investor you are. Before you invest a single rupee or dollar, be honest with yourself. Are you a defensive investor or an enterprising investor? If you are not prepared to spend 10 to 15 hours per week researching individual stocks and financial statements, then you are a defensive investor. Embrace it, own it, and invest accordingly through diversified index funds with low expense ratios. Action step 2. Never invest without a margin of safety. Whatever you buy, whether it's a stock, a bond, or a property, make sure you are paying less than what you believe it's worth. Build in a cushion of at least 20 to 30%. If your analysis says something is worth $100, don't pay more than $70 to $80 for it. Be patient. The discount will come. Action step 3. Stop watching the market every day. This is hard, I know it's hard, but Graham would tell you that obsessively checking your portfolio every day is one of the most destructive things an investor can do. It creates anxiety. It tempts you to react to short-term fluctuations. Set up your portfolio, review it quarterly, and then put your phone down and go live your life. Action step 4. Build an emergency fund before you invest. Graham was obsessed with protecting capital. One of the most important ways to protect your investments is never to put money in the market that you might need in the next 3 to 5 years. Build an emergency fund of 3 to 6 months of living expenses in a safe, liquid account first. Then invest with money you genuinely won't need for the long term. Action step 5. Invest consistently regardless of market conditions. Graham was a strong proponent of what is today called dollar-cost averaging, investing a fixed amount of money at regular intervals regardless of whether the market is up or down. This strategy has been validated by decades of data. By investing consistently, you automatically buy more shares when prices are low and fewer shares when prices are high, bringing your average cost down over time without any complex market timing. All right, everyone, we have covered a lot of ground today, and honestly, we have barely scratched the surface of everything this book has to offer. Benjamin Graham packed The Intelligent Investor with decades of wisdom, research, and hard-won experience. Every single chapter has something valuable to teach. My personal rating, 9.5 out of 10. I give it a 9.5 and not a perfect 10 for one reason only. Some sections of the book, particularly the chapters on analyzing financial statements, can feel dense and technical for complete beginners. But here is my advice. Read those chapters anyway. Read them slowly. Look up the terms you do not understand. because once those concepts click, they're going to save you from making very expensive mistakes. For the content, the wisdom, the timelessness, the applicability, and the genuine life-changing power of the core philosophy, this book deserves a 10 out of 10. The 0.5 deduction is purely for accessibility to first-time readers, nothing more. If you are a complete beginner who wants to understand the fundamentals of investing before putting your money anywhere, read this book. If you are an intermediate investor who has been making emotional decisions and losing money, read this book. If you are a seasoned investor who wants to return to first principles and re-anchor your strategy in timeless wisdom, read this book. The only person who might find limited value here is someone looking exclusively for short-term trading strategies or cryptocurrency investment advice. Graham's world is the world of long-term, value-based, fundamentals-driven investing. If that is not your world, you might need different resources. But if financial freedom through disciplined, long-term investing is your goal, this is your Bible. I want to leave you with something that Graham said because it encapsulates everything we discussed today in just a few words. He said, "The stock market is filled with individuals who know the price of everything, but the value of nothing. Do not be that person. Be someone who understands value. Be someone who exercises discipline. Be someone who thinks long-term. Be someone who protects their capital. Be an intelligent investor, not just a market participant." You have the wisdom now. You have the data. You have the framework. All that remains is for you to take action, consistently, patiently, and intelligently. And I know you will, because you watched this entire video, and that already puts you ahead of 90% of people out there. If this video gave you value, and I believe it genuinely did, please smash that like button right now. It takes you half a second, and it helps this channel more than you know. If you're not subscribed yet, what are you waiting for? Hit subscribe and join the Mano family. We're building something special here, a community of people committed to financial intelligence and long-term wealth building. Drop a comment below and tell me, what was your biggest takeaway from today's video? Or have you read The Intelligent Investor? What lesson hit you the hardest? I read every single comment and I love connecting with this community. I'll see you in the next video. Until then, this is Mano reminding you, invest smart, stay patient, build wealth, and never ever stop learning. Bye.